Hello all, welcome to Pivotal Traders. So today I bring on to you very responsible topic, which is the risk management. And this thing is not being discussed by many of the traders, many of the option sellers particularly. And I do not know why it is not there into the center point, because option selling is all about managing your risk. So if you do not understand the risk you're getting into and what kind of payoffs are there, and if you're not able to compensate the payoff with the risk kind of risk you're taking, that means you're just blindly following the notion of open selling, just ऊपर से बेचो नीचे से बेचो, and that's it. So if you cannot name a particular strategy, that means you're doing something wrong. And when you're doing something wrong, the market is designed in a fashion that you will be net negative or will not be able to have a upper trajectory in the positions of profit. So you have to be very much vigilant about what you're getting into and how you're getting into and what all levels are there for you to hedge, and whether those hedge positions are appropriate or not. So I'll be discussing that exactly, why the how much far can be the hedge and what is the appropriate steps to be taken in order to decide a particular strategy in option selling. So first of all, I'll be doing the exercise in Bank Nifty because that is what is being liked by the traders. And I'll also be telling you why the results are very interesting in terms of the Nifty and the Bank Nifty when we are looking from the lens of the risk. And I recommend that you watch the video till the end and also do comment and subscribe to the channel. So let's quickly jump in. First of all, we'll be discussing about the iron fly. So iron fly is simply a strategy where we sell at the money, call and the puts, and we hedge it with somewhere further away premiums of around whatever is the price, whatever suits you. So this is the monthly expiry 25th of November, and we have done this iron fly strategy here. So what I have done for you guys is not to make the video lengthy. I have done this. You can see that the maximum profit is coming around 19.04%, and the risk reward ratio is 1:6.05, and the estimated margin is somewhere around these. Similarly, the same thing I have done it the for the iron condor, and iron condor also I have done the same for the bank nifty, where I have taken the position around 500 points away. I have also taken position in the iron condor, which is 300 points away and 200 points away respectively. So what all results are there in terms of the risk? Let's quickly jump onto our Excel sheet. So onto our Excel sheet, you see that there are different strategies. So what we have done is we have done iron fly, we have done iron condor, and taken the hedge 700 points away. And it doesn't matter where your hedges are, your spreads are on the call and the put side, but the most important is from wherever the starting point of your call selling or the put selling, how far is your options hedge. So we have simply singled out those points over here, that 700 points away hedge, 500 points away hedge, and 300 points away hedge. So these three things we have identified, and we are trying to know what decisions can be made, what is the right distance for a hedge, and what is the maximum return which we can get. So many option sellers who says that, even in the traders carnival, I cannot name, but what an option seller said that you should keep 150 points away for the nifty and 500 points away for the bank nifty in order to get the maximum returns. But I was not kind of reconciling to the fact, because he is not incorporating the risk factor there. So once you incorporate the risk factor, then it doesn't matter how far you are placing your bets. It only matters whether the probability of that strategy getting success is there or not. So that is what I'll be singling out. I'll be stressing upon that what strategy suits you the best. So if you can see here that the iron fly, the probability of profit is very low, but if you see the risk reward ratio is very lucrative here. So 1:6.05, it is the highest amongst the other strategies which we have taken around iron condor. We have taken iron fly and iron condor precisely because the margin benefits are highest in these strategies, and that's why I'm stressing fact on these strategies only. So if you see here that iron flag gives the maximum reward but the least number of probability. So if you compare this and this, you get confused that whether I should go for the iron fly, whether I should go with the iron condor. So you get confused because the probability is more in iron condor and the risk reward is less. So you kind of having a substitution in terms of the probability, and you're giving away the reward. So it gives a very tough task for us to decide which strategy to go with. So that is what I am trying to simplify over here. I come up with something called adjusted returns. So adjusted returns are simply put, which is incorporating the probability, which is incorporating the profitability and also the risk reward ratio. So all these three are combined in a single numerical figure which can guide you what strategy to take when you're doing option selling, and whether your strategy is prudent enough to hail the risk or not, and how much target should be there, and what can be the expected realization. So to simply talk about it, I'll just disclose over here that I come up with something called adjusted returns. So I'll be discussing all other aspects, don't get scared about it. So let's just focus upon the adjusted returns for the time. So yeah, so if you follow this column over here, I come up with something called adjusted returns. So these adjusted returns are also being highlighted by many of the books of option selling, and surprisingly it is not there on the YouTube, and also it is not there in all the books. Only very rare books discusses about how you can compare your strategies and go about it. So if you can just see over here, we have very interesting fact where we see that the iron fly, even though it had the probability which was very less and the risk reward being around 6, comes out to have only 3% return when we adjust it. So what all are the adjustments? The adjustments are very simple. We take probability, we multiply it with the maximum profitability, then again we multiply it with the reward divided by the risk. So this is what we are doing here in this column here, where this formula is there and which is getting these figures: 3%, 2.67, 2.46, 2.47. So so what you get a sense with these strategies are now comparable. You are able to take a decision out of this single numerical percentage, where you see that the iron fly is giving you 3% return, the maximum, and the iron condor, which is 700 points away, giving you the highest risk adjusted returns of around 2.67%. And if we bring the hedges closer, we see that our profitability is going down to 2.46, and if we bring it little bit more closer, we see that the profitability fails to react about it. Also, if you see the maximum probability which is happening at around 54% in the iron condor, which is 700 points away, we get the maximum probability of success with maximum profitability, and that's why you can see that the adjusted returns are also quite high in this. But you should not get carried away with this, because these are dependent upon the options Greek, the gamma, the alpha, the delta. Everything is involved in this, and more importantly, the IV. So many a times it happens that the par OTM spreads are not decaying, or their values are being higher at a much more than the current at the money premium price of the options. But that is what you have to decide upon. I am just saying that it doesn't matter how much far your hedges are. It only matters that as long as your comparability is correct of the adjusted returns, and you are able to make a decision out of it based upon the scenarios of the price action volume, then you should be able to take a prudent decision about which option strategy to go with. I also went on to analyze whether the additional margin. So if you see here that the least amount of margin is coming at around 300 points away hedge. So that does not mean that you should enter right into this strategy, because if you see here, the maximum adjusted return, which is fair enough, is coming at around the iron condor, which is 700 points away, but it is even higher for the at the money straddle. So straddle, and you're converting it into iron fly. So that means that you should not even go with the least amount of margin. You should also be focusing more upon your strategy and more upon the risk and the probability of that strategy getting a win. So further, if I talk about, I went on to also analyze that the additional, the marginal returns which I'm getting from the different strategies, whether it is good enough to compensate the additional margin which I'm giving away. So what I mean here is that, so if I'm to compare by moving from one strategy to other strategy, whether I will be beneficial or not. So simply put, if I just move from this iron condor which is 500 points away to the iron condor which is 700 points away, for this additional 2.21 percentage returns, I have to give away 4,688 rupees. Now, if I divide both these figures, I get something very negligible amount of zeros. So that means some benefit would be there, some edge would be there, but that is not significant. But remind you that even if a slightest of edge is there in the market, you should be leading the market. You should be in the long run making larger amount of sum which can compound over the period of time and can give you maximum returns. So what I only mean to say is that even though you're giving away additional 4,688 rupees, and if you just have more risk and if you just give away more of your points, you see there is a benefit for you to shift from iron condor to iron fly, which is incentivizing you to get 233 rupees in order to enjoy additional returns of 0.32 percentage. So this is what I'm talking about, that iron fly is giving you good amount of adjusted returns, is giving you good amount of marginal returns, and also incentivizing you to shift from your previous strategy. So that is what I'm talking about, that these all parameters are very important for you when you are analyzing any strategies. So do calculate all your risk, probability, maximum profit and risk reward ratio before jumping into any trade blindly. Okay, so this is what I have to tell about the bank nifty. And if I am to plot this on the graph, this shows very clearly that the adjusted returns which is being denoted here with the sky blue line is very very flat. I mean to say that it is not very different from the other strategies. So it is more or less very flat. And if you look at the risk to reward, it was very high with the iron fly and went down with other strategies. So that's what I would like to stress, that all boils down to the fact that whether the marginal benefit which you're getting with the additional margin which you're spending is positive or not. So even if it is positive with the slightest of numerical, that means you will be having some edge in the long term. And similarly, I have done the same with the nifty also. And there is a good takeaway for you if I say, in nifty also I have done the same things. I have done the iron fly and I have hedged it. And I have similarly I have done the iron condor which is around 250 points away, 200 points away. So both the things I have done here to showcase you what I wanted to say. Let me just go a little down here. So this is what I'm talking about. So if you see here that in nifty also I have done similar kind of exercise where I have done iron fly. I've also done iron condor with hedges of around 250 points away and 150 and 100 points away respectively. Now in these scenarios also very interesting facts are there. If you just compare that, adjusted returns were only 3% in terms of the bank nifty. So the people who says that we get the maximum profits in bank nifty is not the case. You can see that how nifty is also outperforming with the hedges. That also depends upon the kind of strategy we have chosen, but more or less it is very much well defined. Even then you can see that this is a quite significant amount for us to analyze in the nifty here. So you see that the adjusted returns are quite high in terms of the iron fly. And you see here the things are very different in the sense, you see the additional margin which you're giving away for shifting from this strategy to this strategy is 0.13%, and from this strategy to this strategy is around 0.52%. For this you have to give away around 2,500 rupees and additional 4,500 rupees. And if you just want to get little bit more greedy and you want to have more of a premium, then you have to go from here to there. with additional margin which is almost double. There was a strategy which was incentivizing us in the bank nifty to move away from iron condor to iron fly, but that is not happening here. So my only concern is that it does not matter how far you keep your hedges, as long as your adjusted returns are good enough. And and even if there are scenarios where your marginal returns are greater, then you'll be able to decide which strategy to choose from the lot. So that's it guys, I hope you like the video. Do comment, subscribe, and also let me know how is the quality of the channel and whether you need any particular topic to be discussed so we can bring forth and let you know. Thank you so much guys, have a great day, bye bye.